Have you ever seen a commercial for some new pill and think, wait, that might be just what I need? And then you go and ask your doctor. You find out that since you haven't been to the upper Amazon region, it's really not the pill for you. The financial industry has a similar situation. They have products for problems you didn't even know you have. Todd and I are digging into some of the more, let's call them innovative creations that we've seen in our careers, and that's all coming up right now. Hello, welcome back to Wealth Wednesday. I'm Neal Watson, CFP Pro. I'm joined by my good friend and longtime industry veteran, Todd Kempel in Wheeling, West Virginia. Between us, we've seen just about every financial idea, some good, some bad, and some that make you wonder who in the world came up with this.
Yeah, that's true, Neal. You know, a lot of the problems were designed to fix, a lot of the products are designed to fix problems that most people never realized they had until they told them that they had them.
Yeah, and the big problem is that nobody really likes to lose money, even on a temporary basis. And that fear inspires a lot of, we'll call it financial alchemy, promises of good returns without the market's ups and downs.
In the world, we've seen a lot of these magic products, things like an index-linked investments, where returns are going to follow a market index, but with caps or limitations on the upside that your contract won't participate in above a certain number. Is it become a very common form of product.
Yeah, and that the living benefit riders on top of that guarantee at least an income stream in case the worst happens. But sometimes people don't really understand the costs and restrictions, and they don't really address problems that are actually likely to happen.
Make sure we make the point here that these aren't necessarily bad in and of themselves, but there's always a trade-off, Neal, right? You can't erase risk completely and still get market level rewards. There just never is a free lunch. There's always something that's.
Yeah, and it's not just the insurance world either. The investment products are now coming up with things like buffered ETFs, which use some interesting strategies to provide some partial downside protection. But in exchange for that, you're limiting your upside. It's the same piece of mind pitch. It's just packaged a little bit differently.
Version, the buffers only work up to a certain point. Once you reach that point, you're no longer participating in that upside. But that's what you're giving up to get the.
Another favorite problem the industry loves to highlight is that you can never have enough income, especially in retirement. That can be real, but the solutions get extremely creative.
That's true, and especially when rates were a little bit lower, where we saw a lot of products touting the phrase enhanced income investments. That might be the use of options to boost the income that they pay, which sounds good, bigger checks and stuff.
Yeah, but those strategies can limit your upside growth or even expose you to more risk if the market moves the wrong way. That extra income isn't free. You're trading something for it typically.
That's right. And sometimes you might be dipping into principal, Neal, without realizing it. So your bigger paycheck now might shrink your savings.
Yeah, and then here's the newest thing that we've seen come up here in the last few months. It's called the interval fund. It pitches a way to democratize the somewhat mysterious world of private investments.
This is a real interesting one. There's what, 90% of the equity investments are private now, Neal. Public equity markets are not near as diverse as they used to be. So how do I get into those private equity opportunities? There's private real estate, private credit, alternatives, all with supposedly lower volatility and better returns than the overall stock.
Yeah, and on paper, those smoother returns and less drama sound great, but these funds do have limited liquidity, and you might only be able to sell a slice of your holdings a few times a year.
Valuations aren't updated daily. That lower volatility might just mean that you're not seeing those true ups and downs instantly. It may not be until the product is revalued, maybe at the end of the following quarter. It's like owning a house and only checking the value once a year. the market's still moving. You just
Yeah, and this all comes down to, Todd, understanding the actual problem you're trying to solve. Market fluctuations are a feature of stocks, not a bug, and retirement income is always a valid concern, but the fix should fit your situation.
exactly. That's so true. Investing is a mental game. Most people need returns that outpace inflation over time, but most also struggle with the stress of big downturns potentially.
And some of these products, when they're used correctly, can ease that stress and let the core portfolio do its job, but they have to be used very intentionally.
I've used many of these tools in the right situations, and that's a key piece. You don't use the wrong tool for the wrong job. They're not magic cures, and just like with medicine, the side effects shouldn't be worse than the disease. I myself own some of these products, but I have applied them in the proper manner.
Yeah, and the financial world is always good at creating these new ways to solve problems. Some of them are very real and some of them are somewhat imagined, but the side effects are also real. And the biggest one is often buyer's remorse. If you have questions, talk to someone like Todd or myself who can help you sort one of these from the other. And if you found this information helpful and if we've earned it, subscribe to our YouTube channel and like this video. Be sure to hit that notification bell. Thanks for watching. Have a great week.